Anticipation has been the defining emotion of the past year. From the heated 2024 election to the long wait for clarity on the policies of the newly re-elected Trump administration, it seems everyone has been holding their breath. Now, in the early weeks of 2025, we are finally beginning to see the shape of things. Policies taking form, markets reacting, and as always, the implications for precious metals. Gold and silver had a monumental run in 2024, fueled by record-breaking central bank purchases and the expectation of rate cuts. But as we move into 2025, the big question on everyone's mind is, what comes next? With a stronger dollar, shifting macroeconomic forces, and new tariff threats making headlines, the effects on gold and silver are starting to come into focus. Investors have been anxiously waiting to understand how these forces will interact, and now the pieces of the puzzle are falling into place. How will these policies, particularly tariffs and border measures, ripple through the economy? And what do they mean for the precious metals market in the chapters ahead? Before we get started, please take a moment to support our channel by subscribing. It allows us to bring you new stories about precious metals each week. Thank you. What a difference a year makes. 2025 is already shaping up to be a very different year for precious metals than 2024. Last year, gold and silver prices seemed unstoppable, with both achieving record-breaking growth. Central banks made massive purchases, and anticipation of rate cuts fueled further price surges. Nearly every factor aligned to push gold and silver higher. But as the saying goes, there's a new sheriff in town. With his re-election, President Trump is moving fast on a range of aggressive policies, and among them is a revived tariff agenda. While campaign promises are often dismissed as rhetoric, this administration appears ready to follow through, particularly on tariffs. Other policies have begun to take shape, and as expected, their effects are complex and often intertwined. The number one expectation for the prepared investor in 2025 is volatility. Analysts agree that the one-directional momentum of gold in 2024 has likely ended. Macroeconomic shifts are now steering the market in new directions, with a stronger dollar applying pressure on gold's rallies and capping its momentum. Meanwhile, a series of policy changes enacted by the re-elected Trump administration is already making waves, and two issues are front and center: focus on border security and tariffs. On the weekend of January 26th, an incident with Colombia grabbed headlines. The United States deported nearly 100 illegal immigrants via a single flight, individuals who had been arrested and were being sent back to their home country. However, the Colombian president attempted to intervene mid-flight, refusing to allow the plane to land. The Trump administration swiftly responded with economic threats, including a warning about punitive tariffs. Tariffs have long been a double-edged sword in economic history, often creating ripple effects that extend well beyond their intended targets. When it comes to gold, the impact of such policies becomes even harder to predict, as the metal's historical role has shifted alongside evolving market and geopolitical conditions. Yet, by decoding this recent incident and understanding the broader context of tariff usage, we can begin to anticipate how these policies might influence the precious metals market in the months ahead. First, it's clear that tariffs are a means to an end. This incident serves well to remind us that tariffs are not the outcome. They are a bargaining tool to achieve something else. Keeping that in mind, the threat of tariffs should be thought of as a threat, and we should consider that some tariffs will never materialize. Already we have seen examples of the current government using the threat of tariffs in an attempt to return manufacturing to U.S. soil. If tariffs are enacted, their impact will vary depending on scope and target. Broad universal tariffs like those proposed during the campaign would immediately ripple through the economy. More targeted measures, such as those threatened against Colombia, may have little effect. For example, Colombia's coffee exports to the U.S. face stiff competition from other coffee-producing nations. If Colombian coffee became more expensive, consumers would likely switch to alternatives, and competitors might lower prices to capture market share. In such cases, the effect on gold and silver would be negligible. However, this incident could be seen as foreshadowing. Another US neighbor, Mexico, is facing the threat of tariffs, this time a potential 25% rate. Mexico is one of America's largest trading partners, and the tariffs stem from concerns over trade deficits and border security. Unlike Colombia, targeting Mexico would likely have a significant impact on precious metals markets due to the scale and interconnectedness of trade between the two nations. Adding another layer of complexity, Mexico is the world's largest silver producer, with over 100 silver mines within its borders. In 2023, Mexico produced approximately 202 million ounces of silver, accounting for about 24% of global mine production. If tariffs were enacted against Mexico, it's unlikely that silver would be exempt, as the industry is too small to warrant a carve-out. Such tariffs could have significant ripple effects. The impact would be felt in several ways. First, there may be declining demand from the industrial sector as manufacturers seek substitute metals in response. As materials become more expensive, manufacturers might raise prices, further reducing demand. Second, retail silver investment could decline as spot prices may drop and premiums may rise. Supply chains will become more complex as companies will be incentivized to send finished goods into the US from other countries to avoid tariffs. Premiums on spot metal function like any other pricing mechanism in the free market. If risk increases, so does the price. In the case of precious metals, increased risk from the source of supply could cause a temporary increase in premiums. Gold is different for a few reasons. Primarily, gold is traded on exchanges in the form of futures, and it's less common for individuals to take possession of physical gold bars. When someone buys gold futures on an exchange, they are purchasing the right to buy gold at a fixed price at a future date. When the contract expires, the buyer typically extends the date and does not take delivery. This mechanism reduces the risk of gold being affected by tariffs as dramatically as silver could be, since tariffs are primarily targeted at the movement of physical goods. Additionally, Mexico only produces about 3% to 4% of the world's gold supply, further muting the impact from tariffs. Tariffs also impact the strength of the US dollar in some surprising ways. Reviewing the last trade war between the US and China, it's clear that tariffs increase the strength of the US dollar. Tariffs can hurt the economies of trade-dependent nations, weakening their currencies relative to the dollar while simultaneously generating safe haven demand for the dollar. A stronger dollar typically means lower spot prices, especially for gold, which has a long-standing negative correlation to US dollar, underscoring gold's utility as a global currency. Tariffs may never materialize, or they may be enacted briefly to use as leverage. The United States accounts for 83% of Mexico's exports. Tariffs may be damaging to the US, but they would be devastating to Mexico. The threat alone may force the Mexican government to bargain seriously, and the concessions may be enough to prevent tariffs entirely. In 2010, Bon Jovi released the song "The More Things Change" and turned a 161-year-old phrase into a song lyric. In 1849, Alphonse Karr wrote, "The more things change, the more they stay the same." Political prognosticators agree Trump was elected to be a change agent, and change is in the air. But the underlying fundamentals of the current world order remain constant. The forces that propelled gold to new all-time highs in 2024 are still here. Although policies such as tariffs may be destabilizing to precious metals, other elements that form the core of the current bull market are intact. Reckless spending at the highest levels of government will continue, which debases the currency and guarantees inflation. As U.S. debt continues climbing to unsustainable levels, safe haven demand becomes increasingly more prominent and is especially visible among central banks. The biggest buyers of gold are expected to continue stockpiling in 2025 and at a similar pace to 2024. And while tariffs may be a potentially destabilizing force, The Federal Reserve may step in and inject liquidity into markets or lower rates to make borrowing cheaper in response, though their actions have proven unpredictable as of late. If one thing is certain, it's that this year promises to be more volatile than the last. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.